Alright guys, we're going to look at an inventory purchase worksheet. So you need to make sure you go to Blackboard and you print out the worksheet so you can work the worksheet along with me as we go through this particular video. Under the perpetual system, which is the journal entries that we are going to be working with, purchases are always going to use the inventory account. Because under that perpetual system, we are keeping track of what we have in inventory. So when we purchase inventory, it goes into our inventory account. When we sell inventory, it goes out of that inventory account. So we have to keep track of how much our inventory cost us. Now, inventory is going to be anything it takes, the cost of inventory is going to be anything that it takes to get it to us. So if we actually have to pay the freight for inventory that we've ordered, that is part of our inventory cost as well. So those are some of the things that we're going to be looking at or with this worksheet in this chapter. So the first entry that we have is June 1st. ABC purchased $11,000 of inventory, and it gives us terms. Now, when it gives us these terms right here, what those terms mean is on account. So that means that we are going to have to pay this later. So on account, accounts receivable or accounts payable. In this case, it's accounts payable because we are looking at, we have made a purchase. So our P's are going to stay together. The other things that we have to look at is what does 210N/30 mean? Well, what it means is that we are going to have a 2% discount if paid within 10 days. If we don't pay it within 10 days, then the net, the total amount of the bill, is going to be due in 30 days. And that's what that 210 net 30 actually means in this particular entry. Now, the 210 net 30 doesn't really mean anything other than accounts payable for this particular entry. That 210 net 30 means something when we get ready to actually pay for it. And so we'll have to use that information. So when I look at this particular entry, what I am going to find is that I have June the 1st, and we are purchasing inventory. Inventory is an asset account, and we are increasing our inventory account, so that means we increase inventory as a debit. So we would have inventory for $11,000 as our debit. Then we would have our accounts payable, which is a liability. We increase liabilities on the right side, so that's that credit side. So it would be a credit for the $11,000, and this would be the actual journal entry that you have to be able to do for these particular entries. Then we get to the next one. It says ABC paid for the freight charges, and it was $50. So key word that we see right here is the word paid. Well, we know paid means cash, and if we pay for something, our cash balance is going down. That means that the cash will be on the bottom. That is going to be our credit. Now, we are paying for these freight charges, but remember what I told you is that anything dealing with purchases under this perpetual system is going to use that inventory account. So this is part of receiving this inventory, this freight is. So it's part of our inventory cost. So our journal entry here would be on June 1st, we would have inventory as our debit account for the $50, and the other side is going to be that cash because we actually paid it, and that would be on the bottom as our credit. And so that's what we have when we look at paying freight when we are the purchaser or we are buying it. Then we look at ABC returned $1,000 of the merchandise purchased on June 1st. So if they actually make a return here, what this means is that our inventory account is going to go down. It's going to decrease because we no longer have it in our inventory because we returned it to our supplier. Inventory is an asset account. We decrease assets on the right side. So inventory would be our credit because we are decreasing that. The other thing that we are decreasing is accounts payable because we no longer owe this money. If we return that merchandise, then we don't owe on that merchandise. And so our journal entry that we would have for this particular account is we would have the date of June 3rd. You would have accounts payable would be your debit account for that $1,000 we're returning because we no longer owe that money, and it also is no longer in our inventory, so we have to take it out of the inventory, and that would be a credit of $1,000. Now, when we get ready to look at June 9th, it said ABC paid for the merchandise purchased on June 1st. Well, the things that we have to look at here is we really need to look at this accounts payable account because we purchased $11,000 worth of inventory on June 1st, but on June 3rd we returned $1,000. So we actually only owe $10,000 when we get ready to pay for this merchandise. The other thing we have to look at is we had terms of 210 net 30. So if we purchased it on June the 1st and we're going to pay it on June the 9th, then we're within that discount period. So we do have to look and see what our discount amount is actually going to be. Since it is a 2% discount, what we would do is we would take the balance of the amount we owe, which is $10,000. We would multiply that by that 2%, and that means we will have a discount of $200. So the actual amount we're going to write a check for would be the $10,000 minus the $200, or it would be at $9,800. So when we get ready to look at this specific journal entry, you see again the word paid, which means cash. Our cash balance is going down, means it is on the bottom. It is going to be our credit account. So when we look at this, we found that we are going to have cash going out of $9,800. Our accounts payable is also going to be going down, so we would have June 9th. The accounts payable is going to be our debit account for the total amount that we owe, which is $10,000. And you notice once I put that $10,000 in, now we're at zero. We don't owe anything on accounts payable. So we want to make sure that we clear that up completely. The other side of the entry that we know about, we have cash, and we know we're writing a check for $9,800. Well, our debits and credits are not in balance. We need to make sure those are in balance, and the difference there would be $200. Now again, this is a purchase type of an entry. We're paying for something we purchased. So we will be looking at and we will be using this inventory account here because we're actually not paying that $200 for it. So that has to come out of our inventory cost. And that's something that throws some people for a loop. So just remember, when we look at these different entries, and if we go back and look at them all, we had the first entry, we purchased inventory. The second entry, we paid freight for our inventory. The third entry, we had a return, so that comes out of our inventory. And then we actually got a discount, purchase discount, and so that's going to come out of our inventory as well. So you see all of those do have those inventory on them. The last one says, what would our entry be if we waited until June 15th to make the payment? And it would be different because we actually made the purchase on June 1st. If we wait to June 15th to actually pay for this, that is over that 10-day discount period. So we have to pay the full price. Now again, we need to make sure that we are looking at what is currently in accounts payable because we purchased $11,000, but we returned $1,000. So we only owe $10,000. So in this particular journal entry, what we would see here is that on June 15th, we would be decreasing our accounts payable for that $10,000, and we would be paying cash for $10,000. So that would be our journal entry. If we actually paid it after the discount date, we have to pay the full amount that we currently owe. So these are our journal entries looking at the purchase side of inventory. The next thing that we're going to look at on our next worksheet that we're going to have are going to be the sales entries using this perpetual system. So remember, we are using the perpetual system. You can look this stuff up. What you're going to find is there are different entries for periodic systems. We are not learning entries for periodic systems. So make sure that you're only looking at these entries for the perpetual system, and you are looking at those inventory accounts.